Speaking to us now, ladies and gentlemen, is the Governor of the Bank of Ghana. 65 years of promoting effective regulation and supervision have earned for them that pride of place as the Bank of the Year 2 times in a row. Ladies and gentlemen, it's my pleasure to invite him to speak to us on digital leadership for Ghana's banking economy, leading business and government transformation. Dr. Ernest Addison.
First of all, let me applaud the CEO Summit team for the foresight in institutionalizing this annual event that provides a platform for CEOs, policymakers, business leaders, entrepreneurs, among others, to discuss issues of relevant interest that affects their general conduct of business and their quest to continuously seek and advocate policies that will enhance the business environment. You know, as a central bank governor, I'm not going to delve into a topic on digitalization without speaking about the economy. And as you all know, the last 2 years has indeed been a challenging one for policymakers globally. The COVID-19 pandemic and its impact of 2020, the much anticipated recovery in 2021, and the sudden Russian-Ukraine war have all played out to introduce complexities in macroeconomic management and dented confidence. And so my remarks today will focus on restoring confidence in the wake of the recent macroeconomic challenges. Given the uncertainty of the times, I deem this topic as appropriate and offers the opportunity for the business community to soberly reflect on the current trajectory of the Ghanaian economy in the face of multiple shocks. My address on this subject will focus on 3 main points: understanding the challenges, the impact of the sequential shocks on the economy, and the coordinated policy actions to steer the economy back to stability and growth, and ultimately restore confidence. Mr. Chairman, the world economy was impacted by the COVID-19 pandemic in 2020. Starting off as a health crisis, the impact quickly transitioned into an economic and financial crisis, which required synchronized global policy responses. These ranged from large global fiscal stimulus packages, accommodative monetary policies, and macro-prudential regulatory reliefs designed to ensure appropriate liquidity flows in the financial sector to prop up economic activity. Here in Ghana, and within the context of avoiding an economic recession, some of these complementary policies were implemented. Leveraging the ongoing digitalization process rolled out by the government to reduce costs and help cushion the impact of the pandemic. Ladies and gentlemen, you'll recall that although macroeconomic conditions at the end of 2019 remained strong, alongside a fully rejuvenated banking sector that had just undergone reforms, the pandemic introduced serious challenges. Economic activity slowed down sharply due to the restrictive movements and supply disruptions. Inflation doubled to double digits due to increases in food prices. Global supply chain disruptions impacted adversely on trade. Businesses faced severe supply constraints with weak consumer demand and cost-cutting measures, such as reduced working hours and staff layoffs. In addition, the fiscal consolidated path was derailed, and the fiscal responsibility law, with a fiscal rule of a fiscal deficit of 5% of GDP, was suspended to enable the government support the ailing socio-economic conditions that had emerged. These adverse effects threatened to disrupt the considerable gains achieved prior to 2020. However, the policy responses and measures that were implemented helped moderate the impact of COVID-19 somewhat and supported the economic rebound. From 0.5% in 2020, GDP growth bounced to 5.4% in 2021, supported by the services and agricultural sectors. The significant revenue shortfalls combined with increased COVID-related spending resulted in a substantial financing gap, high fiscal deficits, and rising debt levels. These debt sustainability concerns eventually led to the country's sovereign credit downgrades, which technically blocked Ghana out of international capital markets, deepening financing challenges. Distinguished ladies and gentlemen, in addition to the above challenges that complicated the rebound of the economy was another external shock, the Russian-Ukraine war. The war has further worsened supply chain bottlenecks that emerged during the pandemic, triggered global food and fuel price shocks, and resulted in elevated inflation globally. With inflation at historical high levels, central banks all over the world immediately had to shift from the accommodative monetary policy stance that had supported the pandemic to policy tightening. This triggered capital outflows from emerging and developing economies, widened sovereign bond spreads, and put pressures on currencies similar to what we have observed in Ghana. Of course, countries with weakened fundamentals took heavier hits than those with strong fundamentals and buffers. The developments in global capital markets combined with internal challenges that resulted to the ratings downgrade have played out to exacerbate price and exchange rate pressures in the domestic economy. The Ghanaian cedi came under severe pressure in the first quarter of 2022 as offshore investors exited positions in domestic securities at a time when demand for foreign exchange had increased. The foreign exchange pressures, coupled with tight forex liquidity due to the absence from the international capital markets, contributed to the significant currency depreciation. Cumulatively, the Ghana cedi depreciated by 15.8% against the US dollar in the year to 18th May 2022, compared with an appreciation of 0.5% in the same period of 2021. Recent price developments indicate elevated pressures from both domestic and external sources. These include the global energy and food price shock and its consequential upward adjustments in domestic ex-pump petroleum prices and transportation costs, domestic food prices, as well as the pass-through effects of exchange rate depreciation. Headline inflation has increased sharply from 13.9% in January 2022 to 23.6% in April 2022, driven by both food and non-food prices. The Bank of Ghana's inflation target is 8 plus or minus 2%. The current inflation rate of 23.6% is nearly 3 times the central target of the bank and has significantly complicated the conduct of monetary policy, making those of us in charge very uncomfortable. But I am sure that our discomfort cannot be compared to the feeling of the ordinary man in the street who is confronted with these rapid changes in prices on a day-to-day basis. I think we have all begun to appreciate the importance of stability in sustaining livelihoods and standards of living. The developments in the global economy have impacted Ghana strongly, as it is occurring, as I earlier alluded to, in this context of our inability to access capital markets. This has elevated Ghana's external vulnerabilities and translated into balance of payment pressures, although the trade surplus improved somewhat due to higher crude oil export earnings. However, the significant net portfolio reversals and weak inflows into the capital and financial account has resulted in a widening balance of payments outturn, with loss of reserves in the first quarter of 2022. The prevailing tight financing conditions and further policy rate hikes in the advanced economies make the external financing conditions unfavorable and poses real risks to the external outlook. The developments have also impacted government finances and created financing challenges for the budget. The issuance of bonds and securities have not been met with significant uptake by the market. In response, the government has announced a series of expenditure cuts of up to nearly 30% to deal with the situation. It is expected that the $2 billion syndicated facility will provide some relief to both the budget and the balance of payments. Although growth prospects remain positive, these challenges have dampened consumer and business confidence in the domestic economy. The upside risks to inflation outlook are significant, and the second-round effects of upward adjustments in export prices and possible utility tariffs could further amplify inflation pressures in the outlook. We have heard several arguments by stakeholders on the Bank of Ghana's response to the inflation problem, with some stakeholders arguing that these supply-side shocks cannot be resolved by raising the policy rate, especially because the inflation we are experiencing is imported. I took some time during the recent MPC press conference to explain that the bank is very much aware that supply-side shocks are more difficult to deal with. The policy rate tightening emanates from the fact that the NPC assessed that the shocks are becoming embedded in domestic prices. Oil price shocks, for example, sends price impulses and spreads to other prices in the economy, which then affects economic agents' expectations. The monetary policy response is directed at the second-round effects of these supply-side shocks. Consequently, the policy response has been swift, and as you all know, we have seen the implementation of very prudent policies on both the monetary and fiscal side to try to regain stability. Inflation challenge has brought to the fore the importance of stability, which we take for granted, and has clearly shown that macroeconomic stability would be the bedrock to enhance confidence and build back better from the pandemic/war effects. The measures taken so far include the policy rate hikes. Cumulatively since November 2021, we raised the policy rate by 550 basis points. First, 100 basis points in November 2021, then 250 basis points in March 2022, an additional 200 basis points in May. Currently, the rate stands at 19%. These measures are expected to dampen the heightened inflation pressures in the medium term. In addition to the policy rate increases, the bank reversed prudential regulatory reliefs extended to universal banks at the height of the pandemic. Under these measures, the cash reserve ratio was increased to 12%, the capital adequacy ratio reset back to 13%, and the provisioning rate for loans in the other loans exceptionally mentioned category reset back to the pre-pandemic level of 10%. These are intended to withdraw excess liquidity from the system and moderate demand pressures. To ease off increased volatility in the foreign exchange market, the bank extended the forward auctions to include the bulk oil distributing companies. These form part of measures taken by the bank to address foreign exchange liquidity constraints within the local petroleum sector and aid price discovery. On the fiscal side, as I said earlier on, the government announced a nearly 30% expenditure cut while enhancing revenue mobilization measures to ensure the attainment of the deficit target for 2022, as well as the announcement of a syndicated arrangement to help improve the financing of the budget. The monetary policy rate hikes, reversal of the regulatory reliefs, the fiscal measures have all helped to positively impact on the foreign exchange market. And as you're all aware, the local currency has gained some of the first quarter losses. These are positive signals to boost investor confidence in the outlook. Going forward, the bank will continue to implement prudent monetary and external policies to ensure price and exchange rate stability for business growth. These should help re-anchor inflation expectations and restore confidence to the economy. Mr. Chairman, let me now turn to the theme for the day, that is digital leadership for a digital economy. As you're all aware, the bank has been at the forefront of the digitization agenda for close to 2 decades now. This started with the passage of the Payment Systems Act 2003 at 662, which provided the legal and regulatory basis for the introduction of technology in the banking industry. This was followed with the implementation of a real-time gross settlement system, which is the Ghana Interbank Settlement System. This infrastructure significantly improved the efficiency of wholesale and large value interbank funds transfer and liquidity management. In 2007, additional institutional reforms were carried out, which led to the establishment of the Ghana Interbank Payment and Settlement Systems Limited. Since then, GIPS has rapidly transformed the payments ecosystem through the implementation of interoperable interbank retail payment systems, including electronic check clearing, automated clearinghouse for direct debit and credit funds transfer, instant payment, GH-Link card, and mobile money interoperability. At the next phase of the digitization agenda, the bank reinforced the regulatory frameworks to tackle financial exclusion in a practical and affordable manner. This led to the issuance of the branchless banking guidelines in 2008, which provided the regulatory support for mobile money through partnerships between banks and telecommunication companies. A further review of the BBG led to the Electronic Money Issuers and Agents Guideline in 2015 to address some regulatory challenges and boost the adoption of the mobile money concept. These regulatory changes provided the needed boost to the expansion of mobile money operations and set the stage for financial technology in Ghana. The enabling regulatory environment attracted several fintech companies into the ecosystem who introduced innovative digital financial products and services on the back of the mobile money operations. The operations at the time by fintechs were largely unregulated, and to better harness their potential, an extensive review and consolidation of laws, regulations, policies, and guidelines within the payment system was done, leading to the passage of the Payment Systems and Services Act 2019, Act 987, which has since established a conducive environment for inclusive and competitive delivery of digital financial services. Mr. Chairman, in line with the rapid innovation in digital financial services, the bank adopted a regulatory and innovation sandbox approach to support the process. Currently, the sandbox provides live tests of innovative digital financial services products, business models, and supportive technologies in a controlled environment for possible market rollout. More recently, the bank took a major step to explore a central bank digital currency within the framework of the Financial Sector Digitization Program. In partnership with G&D Technology, the bank is currently piloting the issuance of the digital currency. This project presents a unique opportunity to design a technological representation of a fiat currency that will drive financial sector digitization further and also facilitate the government's inclusive digital transformation program. In keeping with the bank's commitment to digitization of the sector, the ECD project is progressing steadily. Since financial inclusion is one of the objectives, the bank has deemed it necessary to test an offline version of the ECD that can be used for consecutive payments between individuals and merchants where there is no connectivity infrastructure, just like cash. Digitizing the offline transactions of rural and frontier households holds the key to creating the necessary market linkages that could result in access to finance. So far, the usage and uptake of the offline version of the ECD is being piloted in a small town called Seshuyasafo in the Western North region. Selected users in that community have been using the ECD for daily purchases such as food, grocery, and drinks. The bank will continue to work with these users to obtain the critical usage data that will inform the decision about the ECD's future after the pilot. These are clearly landmark events in providing digital leadership with the payment systems to lead to a digitized economy in the near future. In conclusion, ladies and gentlemen, the bank remains confident that ongoing policy efforts should help re-anchor inflation expectations, restore confidence in the economy, and ensure that businesses operate in an environment of stability. In this regard, we will work assiduously to ensure inflation stability. Safeguarding inflation will inure benefits to businesses and the poor in society. While working to safeguard macroeconomic stability, the bank will also continue to work with partners in the private sector and other relevant institutions to strengthen the payment ecosystem to support the financial inclusion and digitization. I thank you very much for your kind attention.